fundsupermart.com.
Hi Dan.
Hi.
What is the 2015 outlook of high yield market and specifically the short duration high yield?
Sure. For 2015, we're looking for 6 to 8% for full market high yield total returns this year. For short duration, we're looking for 4 to 6% total return. The yield today on the fund is about 5.3%, so the coupon plus a little bit of capital appreciation.
We have seen weakening of oil prices adversely impacting the high yield market recently. How has it affected Neuberger Berman in the implementation of its short duration high yield strategy, and what are some actions taken by the team in view of this?
Yeah, the high yield market has certainly backed up given the drop in oil prices. We do have energy exposure in the short duration fund. We are in very high quality E&P companies and also gas distribution. We have stress tested our portfolio and think we could take oil at $50 for an extended period of time, being about 3 years, and not have a default in the portfolio. So we're very comfortable with our energy holdings today. To the extent that energy price declines cause outflows in the high yield market, that can adversely affect in the short term what happens in the short duration high yield market.
What are the potential risks we could face going forward for 2015, and how is your strategy positioned to mitigate against this risk?
Sure. Oil prices continue to be volatile. The energy bonds have traded down less with the continued volatility we've seen in the oil space. Additionally, we expect interest rates to rise sometime in the middle of the year. I think the market is expecting that, so I would not expect a lot of volatility from that. If there's additional global risk-off trades, it can affect high yield, particularly as you get outflows from the asset class. And it's hard to tell where those outflows could come from, where that risk can come from.
With the Fed poised to hike rates this year, do you view it as the start of a full-fledged rate hike cycle, or as a one-off rate hike in the long drawn-out normalization of U.S. monetary policy?
Yeah, I do think it's going to take a lot longer to raise rates to a normalized level for the Fed. Typically, when the Fed begins raising rates, they do it by about 200 basis points per year. My guess is they'll be slower to do that this year, particularly given the low rate environment that we find ourselves in globally between the ECB and the Bank of Japan, which have actively lowered rates across the globe. I think that pressure will continue in rates, and I think the Fed will be slower to raise rates over time because of that. Additionally, you've had currency risk and risk in the market increasing, and I think the Fed will be very aware of that risk in the process of raising rates in the U.S.
In relation to the answer, can we expect more volatility from the high yield sector? If so, are bouts of volatility expected to be fleeting or protracted?
Volatility has increased since about July 1 of this year from a variety of different sources. There were geopolitical risks last July which caused outflows in the high yield market. Oil obviously has been a source of volatility in 2014. I have no reason to think volatility will decline, so I think it'll be with us for a while. But I do think that volatility has provided an opportunity within the short duration space. Short duration today trades at about a 5.3% yield to worst. That at the end of June was 3.6%. So you're paid today a lot more for risk in the short duration strategy versus where we were just 6 months ago.
Could protracted volatility signal a change in the fundamentals or outlook for the high yield segment?
We don't think there's an inflection point change in the marketplace. The fundamentals remain strong. GDP in the U.S. is expected to grow about 3%, defaults to remain low about 2.5%. So I'm not worried about a fundamental shift in the marketplace. If, for instance, we were to slip into a global recession, that wouldn't be particularly good for the high yield market in general. It is certainly not our base case that we end up in a global recession. So the short answer to the question is no, I don't expect anything from a rate rise coming up in the near term to signal a change in our expectation for positive growth in the U.S. economy and the fundamental support that that gives.
Thank you.